Treasury prices are up this morning, yields back down near 3.3%. The Fed preparing to buy more long-term debt today, and in D.C. there is a showdown brewing over debt. Now, with more on how he thinks all of this will show up in the markets, we bring in Tom Tucci. He is head of U.S. government bond trading at RBC Capital Markets, one of the 18 primary dealers that trade directly with the Fed, and he is joining us now from his office in New York. Tom, thanks so much for being with us this morning. Before we get to the Fed's moves, I want to talk about Washington, D.C. and this kind of showdown, this collision that seems to be imminent here. Why does Wall Street appear so sanguine?
As far as it relates to the deficit, is
yeah.
what the question is. I don't know if it's sanguine. I think the reality is there's no solutions right now. I mean, we're in a situation where we've had just another round of fiscal stimulus, and the bailouts overall have created quite a fiscal knot. In the situation here, we can't afford to remove the fiscal stimulus from the economy because we're just kind of breaking out and starting to gain some momentum. So it's an issue that, there's pros and cons. One, we need to keep the stimulus alive, but the other, the bigger issue that we're talking about now is the deficit situation. This is unsustainable. We can't continue at this pace, because at this pace, what's going to end up happening is we're going to lose foreign investment because they'll decline the credibility of the U.S. government with this type of debt structure.
So is Wall Street sort of holding up, if you like, between this tension until this tension is resolved, let's just say from two extreme camps, I don't know, Tea Party and the Obama administration? I mean, what should investors be doing until there's a solution found? That's likely to be a while from now.
Right, and I think, the debt ceiling increase isn't scheduled till the beginning of the spring. So we'll see a lot of rhetoric leading up to that. I think, as I said, right now, I don't think there's a viable solution that's in place. I think that's something that we're working to since we came back from the Christmas holiday. In general, I think it will be one of a conservative or protection investment strategy, which is still investing in the shorter end of the yield curve. The longer end of the yield curve will have the bigger play as interest rates move higher, the economy is stronger, and the deficit situation is still unresolved.
Tom, what is your sense of how foreign clients are viewing U.S. Treasuries? Are they losing confidence?
I don't know if it's a loss of confidence. I think that there's other dynamics that are taking place. They've moved assets to other places that have better balanced budget situations. Canada has been at a big advantage as far as their issuance is concerned, because investors are moving in that direction because of where they're at as far as their budgets are concerned. So as an asset class, the U.S. is underperforming other countries that have better balanced budget situations.
Tom, before we let you go, I have to ask you one question here about the Fed. I mean, do the minutes suggest to you that we are going to see a QE3 program?
I think the door is still open on that, but I tell you, with what's happened and the amount of criticism that's taken place, a couple things have happened here. The first QE took place because of distress. The second one took place because of a deflationary threat. That deflationary threat has diminished. The economy has started to come out hot out of the fourth quarter. We know retail sales were very strong coming out of December. We know car sales were very strong last month. The economy, as far as GDP is concerned, is somewhere above 3.5% coming out of the fourth quarter. Now with this fiscal stimulus, it's going to be even stronger. So we're in a situation where, growth will still be a fundamental backwind for the economy here, and I think that's a positive outlook going forward.
Tom, thanks so much for the time. Tom Tucci joining us there from RBC Capital Markets.